Have you ever wondered why a stock doesn't just double overnight when acquisition rumors break? Because the market isn't reacting to the headline, it's reacting to the probability. Right now, Frasers Group is reportedly a frontrunner to acquire Harvey Nichols, one of the UK's most storied luxury retailers. On the surface, this sounds like a perfect setup for explosive stock gains. Consolidation in retail, established brands combining forces, a strategic play in a sector that desperately needs to adapt. The narrative is there, but look at what actually happened to Frasers Group shares in the month following this speculation. The stock opened at one price, then climbed. Over the month, it hit a high and stayed within reasonable bounds, finishing with a gain of 7.83%. That's solid. That's real momentum. But it's not euphoria. It's not the kind of move you see when investors believe an absolute certainty of a deal is about to happen. And that measured reaction tells you something crucial about how real money actually thinks. Compare that to what an uninformed trader might expect. If you heard major retail giant acquires iconic luxury brand, your first instinct might be to imagine unlimited upside. A deal like that could open new markets, combine customer bases, drive synergies. The growth story practically writes itself, and yet the market's actual response was, yes, this is good, but let's stay cautious. Because Frasers Group isn't just betting on the upside. The market is also pricing in execution risk, and in retail, execution risk is substantial. Luxury retail deals are notoriously complex in ways that go far beyond the headline. There's cultural integration to manage between two very different company identities. There's the question of whether two distinct market positions can actually coexist without cannibalization. There's the broader context of UK retail struggling with e-commerce pressure, changing consumer behavior, and shifting wealth demographics. Every one of those factors creates friction. Look at the actual trading range. The stock moved between specific lows and highs over that month. Despite all the acquisition chatter, despite the narrative opportunity, despite the strategic logic, investors kept their positions within a relatively tight band. They didn't panic sell because they thought the deal would destroy value, but they also didn't go all in, acting like this was a guaranteed win. That's not indifference. That's sophisticated risk management. That's the difference between speculation and conviction. Takeover rumors exist in a middle ground. They're real enough that markets acknowledge them, price them impartially, and move based on them. But they're not confirmed enough that investors behave like the outcome is certain. A confirmed deal gets a different reaction, usually a sharper move and different volatility. A collapsed deal gets a completely different reaction, often creating sharp downward pressure. A rumor gets exactly what Frasers Group got. A solid gain, thoughtful positioning, and a clear sense that the market sees both the opportunity and the obstacles. Now, what's actually interesting here isn't just the stock price. It's what the price action tells you about market thinking. Frasers Group acquiring Harvey Nichols would represent one of the UK's more significant retail consolidations in recent years. It would be a combination of two established players trying to compete in an environment where scale and digital capability matter intensely. Luxury retail isn't dead. It's adapting. Brands like these represent real value, but that value exists alongside real risk, and the market knows it. Consider what investors are actually calculating in their heads. If the deal happens, what's the synergy value? How much revenue could realistically be protected or grown? What's the cost of integration? How likely is customer overlap or brand dilution? How does this compare to other uses of that capital? These aren't rhetorical questions, they're mathematical ones. And when you do the math as an institutional investor, you realize the deal isn't a slam dunk. It's a calculated bet. The tighter the trading range despite positive momentum, the more the market is saying, we think this could work, but we're not betting everything on it. Contrast that with a stock that makes a dramatic, sustained surge. That tells you the market believes the outcome is nearly inevitable. Or a stock that wobbles and falls back. That suggests rising doubt about deal probability. Frasers Group's trajectory during this period suggested realistic optimism tempered by legitimate caution. This is how professional traders and investors actually think. They're not chasing headlines. They're reading probability. They're asking the hard questions. What are the odds this deal gets done? What are the odds it creates value if it does? What are the odds something derails it? Then they position accordingly. A measured position to capture the upside if it happens. Enough conviction to make the position meaningful. Not so much commitment that a deal collapse becomes catastrophic. The rumor phase is fundamentally different from the confirmed phase. During rumors, you're essentially betting on probability multiplied by potential payout. During confirmation, you're betting on execution. And execution in retail, especially luxury retail, especially with two different company cultures and customer bases combining, that's where deals get tested by reality. Here's what matters for you. Whenever you see a stock move on acquisition news, look at how it moves. Is it a gradual climb that reflects cautious optimism, or a sharp spike that suggests near certainty? Is the trading range tight or wide? Does the market keep pushing higher or does it level off? Does volatility increase or stay calm? These patterns tell you what institutional investors actually believe about the deal's probability and its value to shareholders. Frasers Group's price action during the Harvey Nichols speculation period shows you exactly how the market thinks. It's not rejecting the opportunity. The gain proves that, but it's not betting the company on it either. And that distinction between acknowledgement and conviction is where most traders miss out. They see the headline and imagine the outcome. The market sees the headline and calculates the probability. One approach makes you a gambler, the other makes you an investor. And Frasers Group's steady, measured climb shows which approach actually works. The market prices probability, not hype, and now you know how to spot the difference.